Whether or not this takes place is something we'll understand from our next guest of the show. Joining me is Sandip Agarwal, Fund Manager of Sowilo Investment Manager. Sandeep, good afternoon. If we look at the markets, they have been consolidating this year, but we are seeing some reversal in flows, a rebound in rupee too. So do you believe that are things finally aligning for our markets?
Hi, good afternoon, and thanks for having me on the show. So, as you rightly mentioned that some time back, our there was kind of mismatch between the realistic valuation and the earnings, and we have seen 3-4 quarters of flattish to declining earnings growth, and as a consequence of that, most of the smart money moved out, and they have invested in alternate markets like Taiwan, South Korea, and few more. And also there was a massive premium which India was commanding at that time. I think in last 1 year, what has happened, that premium has narrowed down substantially, and also our earning growth cycle is now coming back. We also have good rate cuts which RBI has provided. Some liquidity has also come in, and government on its part has done a lot of things to give more money in the hands of common people by way of GST rationalization and also income tax. So I think that 1 year which was painful, where numbers were not coming and valuations were high, I think that is behind, and I believe that in next 1-2 months, as earnings starts coming in, you will see substantial interest for Indian equities again. Remember, this is only country probably in the world, a large economy which is investable, where there is very clear view that for next decade there will be good growth because of the demography and because of other factors in play. So I have zero doubt that we will not do well. I am very, very optimistic. We believe that substantial money from here will be made in Indian equities.
Okay, got it. But Sandeep, you did mention that our valuation premium against emerging markets have significantly narrowed, but earnings growth, that remains quite a problem. So how do you see the next few quarters to pan out, and what would you suggest investors to do from a 1 year time horizon?
So, earnings growth obviously takes time to recover. And what we have seen is that after RBI's injection of liquidity and the more than 100 bips of rate cut which has happened, now, things are turning around, and private capitals are also seen coming back in pockets. So, in my view, while it is very tough to project exactly when it will come, but in my opinion, you will see start seeing green shoots in this quarter numbers, that is December quarter numbers. Already in September quarter's number, if you see, they were far better than the previous quarter. So I think this quarter even will be a bigger positive surprise, and that will give a clue that things are turning into the right direction. So I'm pretty confident that by the end of December, when December quarter numbers come and commentary comes for the March quarter, we will be in a much better position, and it will give a clear sign that earnings is recovering.
Okay, got it. Sandeep, I was speaking to an expert today morning itself, and they said that Nifty could hit about 30,000 by the end of 2026. What's your take? I mean, is there any target horizon for you?
So we generally don't have any target, but I would not deny from that number. I'm very, very optimistic that number will probably come sometime in September, October. That is the way we look at it, because then you will start discounting the latter year numbers, and at that if a fair multiple is given, then we can hit 30,000 Nifty in October, so September, October, between October to December next year. That is very much a possibility.
Okay, all right. Sandeep, what about the broad end of the markets? I mean, today we did see some good participation. Past 3 days we have seen some good participation. What can happen over the next year? I mean, especially from the small caps back pocket, because they have seen quite significant pain.
So, as mentioned that when liquidity was tightening, the biggest pain which came was in the earnings of small cap companies and mid cap companies. Now, with the actions which have been taken by RBI and the government, I think that pain is now behind. And when the earnings come back, they will also come back with a very, very strong bounce back, and you will see substantial money being made in small and mid cap. So, as a house, we are very clear. We don't discriminate between large, mid, and small at all, because we believe what was small day before yesterday was mid yesterday and is large today. We have to find out good quality management, good business model, good moat, good client, and entry barriers and all those things, which are the common thing based on which the company should be valued or business should be valued, and not based on what is the market cap. So if you get these things right, then obviously it gives us an opportunity to compound money very fast. And So hence we are always market cap agnostic and we never discriminate between market cap. We will buy a large cap also if it gives us outsized returns, and we will buy a small cap also if it gives us outsized return. But yes, in this kind of situation, if you have mid and small cap, even if your companies are doing well, they may get hammered for no reason. So that is a downside risk which is always there. But having said that, we think of a 3 to 5 year horizon. We believe that 6 months, 12 months pain we have to endure so that we can make bigger returns.
So do you think that next year is also going to be the year for large caps over mid and small caps?
I don't think so, honestly. I think that mid cap and small cap earnings will bounce back very, very strongly, and there'll be massive outperformance by mid and small caps in next 1 year.
Okay, massive outperformance expected. But from a sectoral perspective, Sandeep, I mean, consumption growth in India, that has been still lagging the GDP growth. If you look at the FMCG volume growth, that is still at about 4 to 5%. GDP growth has been at about 7 to 8%. So what do you think is leading that, and how does the outlook look like going ahead in 2026?
So, we are very negative on the FMCG sector structurally for a long time now. The two reasons: the population growth rate has fallen by more than half in last 20 years. So, the volume growth which you used to get, that has started coming down because of that is also one of the reasons. Second, we believe that there is only so much you can increase on pricing front, because I think that inflation structurally will be much lower level than we have seen in the past 2 decades. So if inflation is, let's say, 200 basis point lower than structurally what it was in last 2 decades, then your obviously pricing power cannot be that much. So I think FMCG will become a 5-6% revenue growth story. In one of the 3 years it could be 10%, and based on that, why should we give 50, 60 or 40 multiple? I don't know. So we never touch any FMCG unless it is a contract manufacturer or someone which is available at a much reasonable price. We generally avoid all the expensive names because we are very sure that you can't get more than 6-7% growth. So we have to pay multiple accordingly, and we are not big fan of paying 4 or 5 times PEG ratios. We are a value focused fund, so we always buy good quality growth at a reasonable price.
Okay, all right. I mean, Sandeep, today we did see the largest foreign transaction deal in the India's financial space, that is your Shriram Finance. So how do you read through this? Because we have seen some good FII stake buying in Yes Bank as well, Federal Bank as well. So, I mean, this comes when the FII participation in cash markets have been quite low. So what's your assessment?
No, so I generally don't comment on stock specific things because we run a PMS and there are disclaimers around. But let me put it this way, that it is a very good, very positive sign. We are seeing consistent inflow of foreign investment in small banks and NBFCs, and two things which happen. One, more better discipline, better regulation, better corporate governance follows, and second, the credit rating goes up and the cost of funds fall. So, it is a very, very big positive for anyone who is getting such big infusion from a foreign partner. So, I think it is going to be very positive, not only for Shriram Finance, but it will be very positive for other companies which are in the space, because it will give a it will give a hope that if they execute well, they manage the corporate governance part well, then they can also get infusion from foreign partners. So I think it is a very good thing for the sector to happen.
Okay. But apart from NBFC, like we discussed, which area is where you find some good growth visibility from here on, and what are you betting on for 2026?
So we have basically gone wrong in our assessment on manufacturing in last 1 year, because last 1 year have been quite weak on the manufacturing front because of lack of pickup in the private capex and also not so much support coming in from somewhere else. But we believe that structurally for next 10 years, India will be manufacturing hub. We have to make our manufacturing right to accommodate so much of new workforce which is coming every year, and to also contain the inflation part. So I think government will definitely push it more going forward. They are doing a lot of things to do that, and I think manufacturing will be biggest value creator in next 10 years in India. And we also like pharma a lot, because pharma we have a very, very big advantage. We used to like 18 months back tech a lot. Now we don't like tech much, because the biggest market for tech, which is the US market, I think there is a saturation in terms of penetration there. There could be some growth from Europe and Middle East and other markets, but I don't think that will suffice to show a substantial growth for the overall companies which are listed, because the base is very big and the base has a substantial component of US. So we love pharma, we love manufacturing, we love water theme, we love recycling theme, we love some of the banks and some of the NBFCs. So that is the way, and some of the services pieces also, and the platform, we are very fond of platforms. So that is the way we design our portfolio and maintain it.
Okay, okay. Well, Sandeep, what about autos? How is this fitting in the piece of the entire theme that you have laid out?
So generally, we buy when everyone is selling, and auto doesn't fit in that category right now. We bought auto 3 years back. We sold around 12 months back. So we have lost the last 30%, 25% upside. So we feel bad about it, but we are happy that we made 70%, 60% before that. So we used to own a lot of names in auto, but we have broadly got out of the space. We have some of the auto anchors now, where we think that next 6, 12 months could be very good.
Okay, okay. Anything that you are cautious at this point of time?
We are very cautious on FMCG. We are very cautious on IT. This too, we are very cautious.
Okay, okay, got it. All right. All right, good conversation, Sandeep, but with that, we have to let you go. Thank you so much for joining and connecting with us.
Thank you, and Happy New Year if we don't connect again till that time. Thank you.
Thank you, thank you. Wish you the best of festivities as well. All right, that's all we have for this edition of Closing Bell. But, it's the second day of consecutive day of gains for the markets. Could be the beginning of the Santa rally or not. That we'll be watching out throughout the week itself. But for now, the market clearly favoring the advances as of now, because the advance decline ratio clearly stood out at about a 5:2. But yes, with that, we have come to an end of this edition of Closing Bell.